Is the worst of the trade war over? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Rupert Mitchell, author of the Blind Squirrel Substack. Hi, Rupert. It's great to see you.
Hi, Maggie. How are you?
I'm doing well. It feels like everyone might be doing well today. I don't know. You'll all tell us. Hey to everybody who's joining us live on YouTube and on Substack. Welcome to all of you. Please feel free to drop your questions or comments in the chat, and we'll get to as many as we can today. Let us know how you're feeling. I mean, these markets are on fire. And also, if you could, please be sure to hit that subscribe button wherever you are listening. That includes you, podcast people. We appreciate it. Really helps us out. So, Rupert, as we sit down here, you're starting your day. Well, actually not quite, but getting close to it. And we are finishing the U.S. session, but stocks took off like a rocket after word that U.S. and China would suspend tariffs as they try to hammer out a more comprehensive deal. The NASDAQ leading the way, finishing up with gains of pretty close to 4%. I mean, now 4.35. So, decently over 4%. S&P 500, 3.26, Dow, 2.8, Russell, 3.38. So this was really widespread, fast reaction. What is your sense? I mean, you're just sort of, all going to wrap your head around this. But based on what we heard over the weekend, does it seem like this has legs? Is it an overreaction given how complicated trade is? What's your sort of gut reaction to those numbers?
Okay, well, I mean, the cash markets clearly outperformed where the futures were when I went to bed last night. But to a certain extent, I'm slightly flying blind if that's not too much on brand. It looks like we've got a trend shift, Maggie. I mean, I think we're way past the worst on the trade war. This administration clearly cares a lot more about stocks than they were pretending. I guess what we need to figure out is, I mean, it looks like when all the dust settles, we're still going to have at least 10% tariffs on goods entering the US at the end of all this. And I suspect that that really is a hard line in the sand for the administration to have something. Whether that's for revenue generation purposes or pride, I don't know. But we need to figure out, one, how much supply chain damage has been done just in the course of the last sort of 4 to 6 weeks, right? Are we going to be watching CNN reports of container ports in Long Beach and Seattle? Are we going to be seeing empty shelves at Costco? I don't know. I don't know, and I'm trying to sort of steer away from that kind of content on the apps. I guess the next thing is, CEO confidence. They've had a bit of a shakeup. How quickly are they gonna get their mojo back and start spending money? But maybe stop firing people. I mean, there's a huge sort of psychological element to this. I think this pause in the trade war is enough to probably keep recession odds down below the 50% mark right now. And my gut feel is if we do get a recession, it'll be a technical one that we read about in about sort of 6 quarters time when they refresh the numbers. So I don't think we're lining up for a gut wrencher. But what was amazing was when I was writing my weekly note yesterday, I thought, why is nobody talking about what's going on Capitol Hill at the moment? This is remarkable. I went to, the Bloomberg.com site, and I could not, scrolling markets, politics, business, I couldn't find a single article on Bloomberg.com of all places about what's going on with the budget reconciliation. And we're only with the long bond at 490 right now. We're within a squeak of where everybody freaked out in early April. So I think taking a step back, I'm still, notwithstanding the move in the dollar today, I'm still a medium-term dollar bear. I'm a big believer in the great asset rotation. I think that's real and that's happening. I'm not a sort of, Kodiak bear when it comes to US equities. I just think that there are better opportunities elsewhere right now. And so
It's
that's
so
kind of
interesting. It's so interesting that you mention the fiscal situation and bonds, because that's what that is, right? The whole budget process. Yes, it's long, it's tedious, but um, this is really bubbling up as something that could be an issue, a problem with bonds. And Mountain Man Trader just posted, "Great day today, but bonds are very concerning. Can stocks keep this up?" And that the bonds were the sort of signal or the lead market that had people concerned about things blowing up, certainly seemed to catch the attention of the Trump administration, as you pointed out, seemed to put Besant in the pole position
yeah.
and next to the president when that started seizing up. So it's a weird day today when you have bonds rallying, but you have the Treasury yield up. I mean, it feels like, just looking at bonds, and I'm sure it's going to be considered a good day, but bond yields moving up that quickly seems like it would eclipse that.
I think so. I think that ultimately there's, we've got this kind of sugar rush in equities today. That's great. And last time we got a 90-day pause, we got a 10% move in equities. This time we get a 3% move in equities. What happens? What happens next time? I mean, ultimately the way this is going is that we're going back to fiscal, right? And if the TCJA goes through 4.5 trillion of additional deficit spending, I think the bond's going to freak out. I really do. And if the bonds freak out, equities freak out too. And it's a pretty simple dynamic. But the administration's got a tough choice again. They like stonks up. They also like tax cuts. They're going to have to make a choice, I guess.
What did you want to find out about the fiscal situation? What were you interested in learning?
The assumptions are, I mean, I think they will get some tariff income, which helps with the deficit. But, if they want to get that full 4.5 trillion through, they're going to have to make some pretty painful political decisions on pay-fors, which this is a very slim majority he's got in Congress. It only takes one or two rebels and he's back to square one. There has to be some kind of compromise.
Who seems like they have leverage in the trade talks right now? Does it seem like it's China? Does it seem US? I think I saw a headline somewhere today saying, well, the market's not only celebrating the fact that there's a 90-day pause, they're also celebrating the fact that adults are now in the room having these discussions. There's an awful lot that's of sort of stock and faith and hope.
I think the most bullish thing about that joint readout was the fact that they've got a named negotiating team on both sides and a protocol for how that works going forward. And, yes, Besant is the grown-up in the administration right now. Now, that's not a fucking high bar, excuse my French, but I mean, he is. And, there is clear jeopardy that both sides feel about these things going badly from here. But we had trade war climb downs in Trump 1, right? And it was often just a question of which faction got to the president first on a given day, and we still have two factions within the administration. The right faction, to my mind, is sitting in the negotiations right now, but things can move around quite quickly.
This is where
I still think that clearly China does not want to lose its best customer, right? But China has patience, and I think that from the perspective of financial assets, U.S. financial assets are still continue to be in rare air compared to Chinese equities, for example. So the downside, just in market prices terms, is considerably greater in U.S. financial assets.
What does this mean for the Fed? Like, are we going to understand the impact on prices now that we're in this sort of, maybe it's paused, maybe they'll be back on, we might have shortages, will they be transitory? Seems like it's going to be a murky environment. What do you think that means for the Fed?
God, he's got a difficult job. He's got a really difficult job because it's you know, we don't know to what extent, even if it's just 10%, these prices are going to get passed on to consumers. At 10%, there is scope for spreading the pain a little bit between producer, importer, and consumer. But will tomorrow's CPI give us a good read? No, probably not. At the same time, going back to what I said earlier, yeah, we've probably avoided a bone crusher of a recession, but is employment at risk, right? I mean, does Powell have a green light from employment numbers? And if so, when are we going to see that? And he's going to be late again. Well, that's the risk. But I with oil bouncing off the lows, to be over complacent around inflation would be very dangerous for him, and he's not going to do it. I mean, he's going to take. I think he's going to take more risk with the employment side of his mandate, and that's a lagging indicator, and so he has to wait longer, and so the chance of him being late, too late, is the real risk here. But from a how do you trade that? I mean, I still really dislike long bonds, and I'm positioned short those. And I was quite excited about my positions in the very front of the curve in SOFR futures. Yeah, I'm probably happier to just hang out in the 2-year note rather than be too sort of levered up into the front end of the curve right now. I still think that credit spreads look ridiculously tight here. Even if the recession odds are coming off, we've got the whole refinancing wave from 2020 to start going through now. Anecdotal stories of deals getting hung in the private credit world, are just beginning to sort of up the volume. There's a lot of supply to absorb, and we're not just talking about, Treasury supply. There's a lot of corporate credit supply that needs to get absorbed, and the spreads are looking completely relaxed in the paddock at the moment. But let's see how long that sticks around there for.
I see we have Rudy in the chat and Palo Macro. Hi guys, Rudy Havenstein is in the chat.
Hi Rudy.
Hi Rudy. So Rupert, you mentioned you're still a believer. I'm going to get to some of your picks because they're really interesting. But you mentioned that you're still a long-term or medium-term dollar bear, and you still believe that the great asset rotation is real. I think that always feels challenging when people see these rips like today. Like if U.S. stocks are, do you see this as just an opportunity for some of those international investors to unload U.S. stocks at a higher price? Is this a slow moving drip, that rotation? Or would you expect to see sizable moves coming out of U.S. equities just based on valuation? How do you see that asset rotation playing out?
So, I mean, the viciousness of these rips up is a function of a lot of technicals, to be honest, related to. I mean, I don't think a lot of institutional market participants are massive buyers of U.S. equities much higher here, and so they've been renting it, and they've been renting it with right tail call options, and when you get a vicious move up like this, you've got a lot of dealer hedging that will accelerate and exacerbate that move upwards. I'm quite happy to take a step back from the squiggle. I mean, like most people, I'm naturally long. I'm just longer elsewhere in the world. I have a sort of chart of truth right now, which is the the SPY, the S&P 500 ETF ratio with the IEFA, which is the MSCI EFA ETF. And if you look at that, we've been in a trend break since late December. Yes, it's reversing right now. And even after today's move, that chart looks pretty weak source in terms of recovery of that, what was a dominant trend for 10 to 15 years. I think in terms of the longer term view, I mean, I just come back to basic maths at the end of the day. There was, with a world in which US equities represents greater than 70% of total market cap, versus even considering the success and the size of the US economy, but that was clearly out of whack, right? We've also now got a world where other governments have a green light to stimulate with fiscal, and I think it's a dirty little secret that equity markets tend to follow fiscal largesse more than anything else. And they say, oh, no, it's earnings. Well, where does earnings growth come from? If the government's spending money at a 7% deficit, they're getting a lot of that money from the government. A lot of those earnings are coming directly or indirectly from the government. So yeah, I'm a big believer in a sort of a normalization of benchmark weightings. I'm not saying that US financial assets are toxic at all. I'm just saying that, if you've got euro denominated liabilities right now, having 80% of your assets in US dollars doesn't make a great deal of sense. Yeah, it was great while the momentum trade was working, but that's stalled. That momentum trade has clearly stalled.
Despite we see on the radar today. Again, just to remind everyone, we're talking about medium term here, not short term action.
Absolutely. And I wouldn't get any sleep at all if I was trading with squiggles. But I'll send you that chart so that you can put it in your write-up note.
That would be amazing. Yeah, we'll put it in the Substack write-up. Yeah. And just before we move on to your picks, I just want to let everybody know, you may already be signed up and watching. Malton Economics has their conference happening, their SIC conference. Now, it's over the course of a couple of weeks, different days. They have a great lineup. I'm going to be catching up with Juliette Declercq on the 19th, on May 19th. She's going to give us an update on the worldview. Juliette, you remember when we talked to her early this year, was really early to sort of see this global reset. She has some interesting thoughts on where she thinks it's headed next. So we dropped a link in the description and in the chat. I'll try to put it in there. Sign up. And check it out. I think it's going to be a really interesting conversation. Just know that the link we drop is an affiliate link, so we may earn a small commission if you hit through that. But be sure to find it and check it out. I think it's going to be a really interesting time to talk about a lot of the things that Rupert brought up on that macro level. So if that's the case, Rupert, where do you see opportunities? Clearly not in the US. You think that's played out. Where's the momentum now? Where do you think the best opportunity is now? What are you looking at?
Well, I try to think thematically, and oftentimes within themes, there are going to be more stocks in the US than there are anywhere else. So, I love financial exchanges, for example, right? And, the biggest ones on the planet are in the US. But I think that, financial exchanges has been a wonderful way to play this great rotation. I recently rejoined the Canadian oil mafia after a 3-year hiatus. You remember #com? I'm back in there. In trueness to better to be lucky than good. I literally bought the low last Monday in the Canadian energy stocks, which means that's going to definitely rip my face off in Substage in the next couple of weeks, because you don't get that lucky that quickly. Yeah, it's the second mouse that catches that gets the cheese, I think is what people say.
Adam is saying I got some Canada oil plays too, so you're in that mafia together.
It's a much loved asset class. But my thesis there is that most of the Canadian energy bulls were sort of salivating at the prospect of Pierre Poilievre winning the election the other day. And my thesis was pretty straightforward, which is that actually the sort of geopolitical events of the last few months had made it essential for governments of either stripe to make the Canadian economy, and specifically the Canadian energy sector, less reliant on a monopsony relationship with the US when it comes to their energy. And I basically saw Carney and Poilievre as the same outcome from that perspective. And the misery from the Canadian oil mafia was sort of overdone off the back of that election. So I thought that was the perfect time to pounce.
What about technology? So, I think that this is where people try to, they may have a narrative and then they try to lay it over what's happening in markets. And there are an awful lot of people who look at technology and just say, listen, we kind of know tech's eating the world, right? Like, obviously there are all these innovations happening. So much of that had been, it seemed, based in the US. Are you looking at China as the next tech play? How does tech fit into or are you looking more at energy and some of these other sort of, sectors that you think have more room to run? How are you thinking about the tech narrative?
So I have a big overweight position in Chinese equities right now. But I typically, it comes from my background. I've spent most of my adult life in Asia, and so I have a sort of higher degree of familiarity and comfort with the asset class than most of your audience, Maggie. But I have typically, in recent months, tried to steer away from what I see as a sort of the classic sort of China tech ADR names, because they really do get buffeted around a bit too much on sentiment and hot money flows. So I own a bunch of consumer plays. We talked about this last time I was on, a bunch of consumer plays around the beer companies, the spirits companies, some of the retailers, some of the restaurant chains, but typically in the H-shares, in the Hong Kong local stocks. In terms of sort of high level, tech themes, I still think that the AI is in a sort of show me the monetization phase. I mean, I think that the hyperscaler is going to carry on spending. They've started, so they'll finish in the game show parlance, and they really can't climb down. But I was reading some interesting. Some really interesting articles over the weekend around people that were sort of employing CoreWeave style models. So developing specialist AI data centers, which they would then hope to lease on to a hyperscaler, are finding their vacancy rates a lot higher than they were expecting right now. So I think, the self-owned and operated, CapEx continues, but if you like the spillover capacity is sucking wind a little bit right now.
Yeah, that's a great point.
And then generally, and just going back to sort of the sort of classic Web 2.0 stories, the business of selling dollar bills for 50 cents until you have a monopoly share of a market when you can extract rents. I think that's game over. Right, I don't see. Absent the bone crushing recession that I'm not seeing right now. We're in a higher interest rate environment for a while, I suspect, and those businesses, really only thrived in a free money world, and so I'm looking at the DoorDashes, the Instacarts, and a lot of the consumer and enterprise SaaS plays, and going, you guys are not making enough money. I'm not sure that the ratings will be tolerated for much longer. I think we're very much in a show me world.
Yeah.
And I think going forward, generally, you just need to be much closer to shorter duration assets that are generating real cash.
Yeah. And this is why we keep going back to the Treasury market and why those rates are so important. We have a lot of people asking to go back to the Canadian oil. A lot of people asking about pipelines related to this. So, how are you, like, what are you, is it specific to Canadian oil? Are you thinking about oil, the energy complex more broadly?
The gem of the asset of Canadian energy is that they have massive reserves which are incredibly slow to decline. The only problem they have is that in many ways that asset is trapped by the absence of export infrastructure that can get their oil and their LNG and their natural gas to turn into LNG to be able to prosecute both Pacific and Atlantic export markets.
Hmm.
Away from that, they're just they're just exporting south to the US at a discount. And and to make matters even worse, they end up re-importing refined products. 1 in every 8 barrels of refined product consumed by Canada has had some margin tacked onto it by US refiners. So this is critical for them for rebalancing their economy. And there has been political opposition from the progressive branches of Canadian politics to pipeline infrastructure in particular, which is why your comments box is littered with pipeline questions.
Yeah.
And I now think that Carney's got the political will, and frankly, apart from anything else, he's got to stave off an internal constitutional crisis himself with the Albertans right now. Who are definitely sort of sounding slightly secessionist curious right now, and critical to their interests is having their energy assets considered more highly in Ottawa. Should we put it that way?
Yeah. Is anyone
And
taking that?
the other thing is,
Quebec never managed to do it. So would Alberta really
well,
do it?
the other thing is a lot of people go, well, oh, Mark Carney, he's a classic sort of Davos man. And I don't know, many people spotted it, but one of the sort of high priests of Davos world, Tony Blair, the former UK Prime Minister, published a pretty controversial paper about 3 weeks ago. Actually, I think it's the 4th week of April. Basically, going, we've got over our skis on this whole net zero debate. And essentially, one of the Davos high priests was going, giving Carney a green light, quite frankly, to, maybe play it a bit harsher with the progressive end of his political spectrum. He's got a green light.
Yeah. Well, and I mean, and if he didn't have it before that, Donald Trump certainly gave it to him, right? I mean, that was one of the byproducts of him coming out so strongly. It kind of gave a pass to maybe people who would not have been elected or have been booted out, who were in that mold, because now there's something to unite against in a way.
Yeah.
Wanted to ask you before we go about robo taxis, because I think, did you just finish a podcast on this? Are you in that?
Yeah, no, I wrote a piece about the reason being it was last week with the 2 antitrust cases against Google. Now, Google's the sort of 1 Mag 7 stocks that value boards like us are curious about, right? Because it just seems to trade at such a massive discount to its sum of parts. And I didn't want to write yet another sum of parts piece, but having spent part of my career in the world of EVs and EVs and AVs come in the same breath, I did want to pull on a thread, which was some of the bonkers valuations that have been put on Waymo, when people do their sum of parts, they, well, they go, YouTube's got to be worth at least what Netflix is worth. Well, is Netflix really worth $500 billion? But anyway, that's a separate topic. Waymo at up to $1 trillion, pull the other one, it's got bells on it. Ultimately, everyone, it's robo taxis is a business model that's born in Excel spreadsheets, right? And born in a ZERP world. Ultimately, you can calculate with Excel, revenue per mile assumptions, and it all looks perfectly sensible, and the hockey stick goes up steeply to the right, etc. And you can talk about, well, Waymo is going to get a 50% share of the total addressable market for taxis everywhere on the planet and Mars. And you go, okay, so let's think about this a little bit. Who's going to own all these cars, right? The thing about the sort of your Uber driver, he owns or he leases his car. So is Google going to have 25,000 robo taxis on its balance sheet? Now, it's probably the best company on the planet with a balance sheet that could support that, but they're not going to do that, right? I mean, no one's talking about creating specialist structured finance vehicles to warehouse these robo taxis. And we've got car rental. I was facetiously saying, we already are able to invest in fleets of driverless cars. It's called Hertz and Budget, right? I'm not trying to be completely facetious, but the economics and the depreciation schedules on these things are very different. A lot of people are assuming that you're going to get, 300,000 to 400,000 miles out of these cars. Well, the rental companies recycle their cars after 50,000 miles, often a lot less, right? Now, obviously, they're going to be looked after a bit better than a rental car, but I think people are not properly interrogating the cost and the balance sheet side of the business. And the other thing is legal liability. Right now, Waymo, with its 2,500 robo taxis, effectively self-insures, right? But it's in charge of the whole exercise, soup to nuts. You're in sort of pretty specialized test case markets right now. 4 cities in the US. The moment you start to introduce third parties, which is necessary for scaling, right? Someone to provide the balance sheet, etc. Someone to help operate these fleets. You're starting to divide up responsibility around liability. It all starts to get very messy. Now, I am really happy to concede that the software and the technology is there, and that Waymo driver is a better driver than me, and that most other car users. But someone's gonna get run over. Someone's going to have a crash. And last time I checked, there were 1.32 million attorneys in the US, which is like a very, very, very healthy multiple to the number of robo taxis on the road. And, litigation's a national pastime for you guys. So I think
that's a tough constituency to go up against.
Not a lot of thought has been given to this. Really tough not to get excited about robo taxis and driverless cars. This was the tech future we were promised, while we had to endure the sort of societal cancer that is Facebook and everything else on social media. But there's a lot of thinking that's still to be done. Now, I think that ultimately the future for Waymo is as a software / infrastructure provider to much more broadly to the auto OEMs and other sort of natural fleet owners. I have a sinking feeling that private credit is going to own a lot of. They're going to call it autonomous infrastructure. Is going to be a new bucket for dumping other people's money into. But I think that Waymo Driver, the software, will be the overlay there, and it'll be an attractive software play, but not a $1 trillion business. Well, at least not in the near term. So anyway, not really. I mean, at the end of the day, the last round of Waymo valued it at $45 billion, which is a rounding error in terms of the NAV of Google. So, the Google bulls, all I'm saying is that, it's still in science project territory in terms of your NAV analysis. You need to get ad tech and search right. And that you need to be spending 99% of your time figuring out if that's right, your assumptions on that front.
Yeah. And this is why analysis matters, I think. By the way, that pod, A Furry Tale Ending, just dropped on Substack if you want to check it out. Jack, you're right. The 10-year Treasury at 4.4 is the big news, which is why we talked about it a lot in the beginning of the show. If you join late, go back and have a rewind of that. I also talked about it a lot with Harry Melandri on Friday. We had a great discussion, so go back and check that out as well. Or you could read the Substack write-up about that. We are right to keep Treasuries front and center, as Rupert is certainly doing. And Ched said, thank you for that perspective on robo-taxis. I was bullish. He's going to check that out. All fantastic stuff. Rupert, it is always so wonderful to catch up with you. I think right now it's really important. We say this all the time to kind of have a global perspective on this. And, that news today understandably shot things up, but it's going to be what looks like a long slog and a really interesting summer as that budget battle comes into focus and wrecking the treasuries. What do you think let's end with this. Do you still see that sort of 5% level as the no-go zone? What's the pain threshold before things start getting the rest of the market starts getting nervous?
I think we're within 10 or 15 basis points in yield, either on the 10 or the 30-year, from people going, "Ugh," and people, that's Fright Night territory. So yeah, I think we're a lot closer to the pain point in yields than cash equity markets today would suggest.
Which is something we need to be aware of. Rupert, thank you so much. Total delight to catch up with you. We put Rupert's info, we always do, we'll put it in the Substack so you know where to find him, and then we'll of course post a write-up on this tomorrow on Substack. Appreciate you, Rupert.
Well, Maggie, I'm going to put a special Maggie Lake coupon code for you to stick in your Substack as well.
Thank you so much.
The thousands of Maggie fans that occupy your chat can take advantage of that.
And it's a smart bunch, that's for sure. Just a heads up, folks, I'm going to do a Substack live tomorrow at 9 a.m. with to continue with this view from Asia with Pietro Vantani from Swerve Insights. We're going to be talking about investment strategy in a post-tariff world. I'm sure we'll hit on stablecoins a little bit too. I hope you can join us for that. In the meantime, Rupert, thank you. Thanks to all of you. It's going to be an interesting week. As always, take care and good luck out there.
Thanks, Maggie.